What is a Santa Rally? By now you might have seen articles or videos discussing the potential of a Santa Claus Rally into the back end of December. But you might wonder, what actually is the Santa Rally and how does it impact us as investors? Today we're going to discuss it all. We'll talk about the Santa Rally, why individual investors have looked at this anomaly as a fascinating one to observe at the back end of the year, and then we'll also talk about how it's evolved and what it could mean for us as individual investors over this next period up ahead. It's a fascinating time on markets. If you do enjoy this video, don't forget to hit the like button. Feel free to share it out as well. If you're new here, welcome. Make sure you've subscribed and turn your bell notifications on so you won't miss any of our daily episodes. Before exploring and defining the Santa Rally and what it actually means, it makes sense for us to take a bit of a step back and think about seasonality. Seasonality is an important factor to understand not only for markets, but when you're analysing any sets of data. The definition of seasonality is it is a characteristic of a time series where the data experiences regular and predictable changes each calendar year. You can see here there's a visual by equityclock.com that provides an insight into S&P 500 index seasonality. Over the year, we know that there's often an early jump into January, which we'll talk about later in this video, before the back end of February and March are seasonally weaker. Of course, we know that the back end of the year is traditionally a stronger period as well, and all of that feeds into seasonality. So at its core, seasonality shows us repeatable trends over periods. Now, of course, as we know and we talk about a lot, the markets are always a balance of probabilities. There is no sure bet on the markets. Everything is just that balance of probabilities, but the larger a data set, the more data inputs that we're able to use to form our decisions, the higher the confidence we can have of said probabilities. What's interesting as well is that additional layer when, of course, seasonality and market dynamics matches up or pairs with market sentiment too. And seasonality can also become self-fulfilling in that same way. But as we know, it is that balance of probabilities, the same way that you can still have a sunny day during the depths of winter. Of course, you can have good periods on the markets during periods that often are considered seasonally weak, and the same thing on the other side too. Would love to know your thoughts, so drop in a comment below what you think about the Santa Rally. Do you think we've got a Santa Rally on the horizon ahead of us, and how it's influencing your decisions if it is on the markets? And so that then brings us to the Santa Rally. So the Santa Rally's got quite a broad definition, but traditionally it's been distilled down to the last 5 trading days of December and then the first 2 of the new year. So it's traditionally a 7-day period that is used for the analysis. The average Santa Claus Rally, of course, it will depend on which index you're looking at. It will depend on what time horizons or time frames you're analysing back to. But traditionally, the average Santa Claus Rally across this 7-day period, it's seen that positive returns are achieved around 70+% of the time, depending on the time horizons. And now if we compare that to any other 7-day period on markets throughout the year, which is normally in that mid-50s%, there is definitely an uplift. And I think what's really interesting as well is that the average gain over those periods is often above the 1% mark for those 7-day periods considered in the Santa Rally. Now, if you do think about it, we've got over 250 trading days on the markets each year. This is only a 7-day period. However, when you annualize it out, it starts getting interesting when you realize that there's a significant amount of upside and gains often in this period, because if it's an average of 1+% gains, it annualizes out at around that 50% mark too. Of course, it's been different over periods of time. Not every year we will have that Santa Rally. It is that balance of probabilities, but to achieve positive returns over that period, over 70% of the time, it's definitely an anomaly that makes investors and analysts sit up. And so you might be wondering, okay, what are those factors that have contributed into this Santa Rally period that we are now familiar with? As always, like anything on the markets, it's a confluence of factors. We can't distill it down to just one individual input, but there's a few different factors that are interesting. Firstly, it's the holiday season. Institutional investors go on holidays typically during that period. They've normally finalized their positions. Often we know that retail investors can be much more exuberant and volumes are generally lighter during this period as well. So that's one contributing factor. Then for the end of year as well, we know that many different nations have their end of year periods ending on December the 31st. So often there's cash bonuses for the holiday season, and there could be end of year positioning and rebalancing for different funds as well as potential tax loss selling that might end coming into the Santa Rally. So people try to finalize their position for the new year. And then building on top of that as well, there is another effect, which is called the January effect. The January effect speaks about the opportunity of January being a seasonally stronger month initially. The January effect over time potentially has started to fade, or at least it's not as prominent as it once was. But often there's a few factors that might feed into that. Firstly, we know during Christmas and the December period, people are shopping, they're exuberant, they're spending more to hang out with their friends and family, they're buying food and clothes and other items and gifts. And so often individuals will be watching for strong reports to come through for that December period into January. So there may be some early positioning for that. As well, tax loss selling, as we mentioned, would be ending in that December period, and so investors may look to get a bit of that uplift in the January effect or take those positions on the back of what would be considered cheaper prices. So there was considerations that maybe the Santa Rally was people taking some earlier positioning for the January effect. I think underpinning all of that, however, is the fact that the Christmas period is naturally an enthusiastic one. We know that, of course, it's not only fundamentals that drive the markets, but sentiment can as well. People are excited. They're optimistic generally about the new year up ahead. People are willing to spend more during the Christmas period too. So all of that can also feed into the optimism and the mindset for how investors are perceiving this Santa Rally period on the market. And so for our upcoming potential Santa Rally at the back end of this year, there of course are other contributing factors that we need to consider. First and foremost, we've got the US CPI inflation print out of the way now. That happened at the back end of last week, 6.8%. It's a hot print. It was the hottest print for inflation that we've had in around 40 years. And now we've got the upcoming final Federal Reserve meeting on December 14th and 15th. Well, there will be discussions about potentially speeding up the taper, which is running at $15 billion a month, coming down with $120 billion we're starting at. The taper would end around that midpoint next year in 2022, before, of course, the Fed could consider raising rates. But there'll be discussions about the raising of rates and about speeding up that taper. So all eyes will be on that. We do know our current position is probably favourable in comparison to the fact that we've just had a pullback recently. Without that pullback, if we just continued going higher, there may have been some uncertainties about whether we were starting to get stretched. But with that pullback, we've got a more favourable position than where we were sitting just a while ago. We know the VIX and volatility continues to subside as well. As you can see here on the right, the VIX peaked above that 30 mark. There was a sharp uplift on the back of the Omicron variant discussion and the Fed positioning slightly more hawkish with Jay Powell having his discussion. And the VIX is now back below that 20 mark. As the volatility subsides, of course, that's accommodative and supportive for markets to be able to move higher. But we do know there is the uncertainty still about any further Omicron news or additional virus news and any lockdowns, as we know that virus cases are increasing in some spaces in the Northern Hemisphere. Overall, on the balance of all things, it does look like the near-term risks appear to be fading and able to be digested by the market. So it's going to be interesting to see if this Santa Rally does eventuate over this upcoming period. And so, bringing it all back together, what does it all mean for us as investors? First and foremost, if you did enjoy the video, don't forget to hit the like button. Feel free to share it out. If you're new here, welcome. We make daily videos each and every day, so make sure you've subscribed. Turn your bell notifications on as well. You won't miss any of our daily episodes. I guess first and foremost, it can definitely be important for day traders and swing traders, those who are trying to claim pips or trying to get some uplift at the back end of the year. It definitely could be formative for their strategies over this next period. We have seen, however, that there's often been a pullback in early December before the rally, which we actually did see this year as well eventuate, before a potential hangover in January as well, after that initial gain in the early period. Who knows how this will play out? As we mentioned, it's a balance of probabilities, but it is worth noting that. But I do think it's important to remember that if we are long-term investors, then it shouldn't really affect our long-term strategies. As long-term investors, the day-to-day can be interesting to watch. It can provide us with insights. It can be fascinating, but we should be focusing on a longer-term time horizon. And so ultimately, if you are a longer-term investor, it probably won't change too much about your strategy. But of course, it's an interesting anomaly to observe, and it's one that attracts a lot of attention coming into the back end of the year as well. If you did enjoy this video, let us know your thoughts. Drop in a comment below. Not long till the end of the year. What a year 2021's been. It's going to be fascinating to see how it all plays out. Thank you so much for joining us. For now, stay well and happy investing.